Thank you all very much for joining us this morning. My name is Steve McMenamin. I'd like to welcome you to our continuing series of the Greenwich Roundtable. And today's our topic this morning, winning in Lilliput, adding value in microcaps, is, believe it or not, the first time we've examined this equity strategy that seems to be below everyone's radar. I'll briefly introduce our speakers after I say this. The speakers' views are their own and don't necessarily reflect the views of the Roundtable, its board, or the staff. Now, having said that, sitting to Ryan's left, Brian Bears is the founder of Bears Capital Management, an asset management firm that runs a long-only, concentrated microcap equity strategy out of Austin, Texas. A little bit like Pope Francis, Brian calls himself simply a research analyst and he doesn't run a hedge fund. And so before starting Bears and after graduating from the University of Nebraska, Brian worked his way up from compliance and operations to trading and portfolio management. He earned his spurs in nearly all aspects of running a boutique small cap manager before starting his own company. Mr. Bears is the author of The Small Cap Advantage, How Top Endowments and Foundations Turn Small Stocks into Big Returns. Sitting to the left of Brian is Tom Lynch. Tom is the founder of Mill Road Capital, a Greenwich-based microcap private equity manager. Before starting Mill Road in 2004, Mr. Lynch founded Lazard Capital Partners, a private equity investment group. Before Lazard, Tom was the first investment professional to work exclusively in the private equity group at Blackstone. Before that, he was a project manager for the Monitor Company, a consulting firm founded by Michael Porter. Mr. Lynch is the chairman of the board of Rubio's Restaurants and a member of several public, private, and not-for-profit boards. And sitting to Tom's left, Adam McConkey is a London-based portfolio manager and director of the UK smaller companies at the Henderson Group, which is headquartered in Dublin. Since 2006, Mr. McConkey has co-managed the AlphaGen Volantis Hedge Fund, the UK Best Ideas book, with Rob Giles, as well as Henderson's fledgling trust. Adam spent more than a decade at the Gartmore Group, which was acquired by Henderson in 2011, where he was head of Gartmore's UK Smaller Companies team and the Pan-European Smaller Companies Fund. And today's moderator is Ryan Dartnell. Ryan organized today's session after thoroughly researching and committing capital to this strategy. Ryan is the Chief Investment Officer for Granite Associates, a much-beloved family office based in Liberty, New York, and a trustee of the Roundtable. And Ryan, if you would.
Thank you very much, Steve. Thank you all for being here. It's nice to see a lot of friends in the audience. Thank you especially to our speakers. Adam on the far left has come the farthest from London, and Brian Bears has come the second farthest from beautiful Austin, Texas, and Tom Lynch has stumbled down Greenwich Avenue from his office there. I will say that Tom's probably the one who's worked the hardest to be here. He's battling the flu, so thank you, Tom, for rallying for us. Before doing this, doing some research, I consulted with my Ibbetson's annual report just to make sure the facts were straight. And from 1926 until today, the outperformance of small cap, not microcap, but microcaps are in the same league, has been about 5% a year for many, many years. On a shorter term basis, 1992 till today, the outperformance is 15.6 versus 9.6. And more recent years, interestingly, it's been a bit more neck and neck. And I guess the last thing I'll say before handing over to the experts is that there are a lot of companies to choose from. Jimmy Wan, who works with me, helped me yesterday. We were looking at the Russell 3000. The bottom 1,000 companies in the Russell 3000 make up 1.5% of the Russell 3000. So 1,000 companies make up 1.5%. So a lot to fish for. So to hear from all of our speakers early on, and also just to get a sense for the universe, I thought it would be useful just to ask them about the opportunity set and their universe. And in deference to Adam coming the farthest, I'm going to start with him. Adam?
Thank you, Ryan. Very kind of you for the invitation. I think a little trepidation on my part as well. I spent probably the best part of the last decade treading the boards, extolling the virtues of investing in microcaps, particularly the AIM market in the UK. And I've never been convinced that everyone's really listening. The door's rarely been ajar. So it's an indulgence and a treat to be here today, but such is the paranoia of a fund manager, it introduces a little worry that you're being invited to an occasion like this. Not least that last year was the first year in 20 that we saw inflows into this asset class in the UK. So I'm very grateful for the invite. Ryan asked me to speak first just about AIM. I'm very conscious that I suspect not everybody here is familiar with the microcap university in the UK. There'll be a lot of commonality, I'm sure, in successful criteria for investing in microcaps, but it's probably worth spending a couple of minutes doing a bit of scene setting in the UK. Not least, I suspect US experience probably of AIM, if I recount some of the rhetoric coming out of the regulator and New York Stock Exchange at the time that they were bidding for the London Stock Exchange a few years ago. It was described as a cowboy market and a casino, which is some way from the truth. AIM is London's junior market. It's where the majority of smaller companies reside and list publicly in the UK. It's an investment universe of give or take 1,100 companies. The majority of those companies are sub 250 million, about 90% of them sub 250 million sterling in market cap, and in fact actually a good 900 of those are less than 100 million in market cap. The average size is typically a market cap of around 75 million, and it's a very rich and diverse tapestry. There's a broad range of sectors, as you would imagine. Typically domestically incorporated, but very, very international flavour too. It's really become an international microcap asset class over the years. Now, if that sets the scene a little bit on some facts, those facts are obviously a little dry. I think what's more interesting is a little colour around the story of AIM. And if you'll indulge me a second, I'd like to talk a little bit to supply, and that's there are two stories to AIM. The first is supply, the history of AIM pre-2008, and the other is demand and the lack of interest in AIM post-2008. So pre-credit crisis, AIM exploded. The way the credit cycle impacted smaller companies in the UK was not access to too much debt, not access to complex financial instruments. It was effectively too many critters had a chance to have a go. If I was sat here in 2003, I'd be talking about 300 or 400 names. By the time we got to 2007, there were 1,600 names listed on the stock market. And the wash of capital that was around just meant that too many companies listed that probably weren't ready and were doing so because they could rather than they should. And you particularly ended up with a mismatch between underlying investors and the commitment, the nature of the investments they were making. So the last few years have really been about a clearing process, fantastic opportunity set in that respect. But something much more interesting has also happened on the demand side post 2008. And that encaptures a rise in risk aversion more generally. It encaptures a change in attitude around regulators. And if you don't mind, I'd like to share a story about a chap called Neil Woodford in the UK. Which sort of reflects some of this. Neil Woodford would be the UK's equivalent to Bill Gross. Incredibly successful investor, track record going back 20 to 25 years, built up in a conservative style, income investor, a 30 billion asset pool at Invesco. I know that's not huge in US terms, but that's massive in the UK stock market. Massive supporter also of smaller companies. He would have invested regularly in smaller companies, very often in microcap companies, taking 20, 30, 40% stakes, but also invested in businesses pre-revenue occasionally and often without dividend. Post-credit crisis, it's very difficult for an income investor to go down that route. He has recently left Invesco, and now the reasons he's left have never been publicly articulated, so this is my read of the situation. What's changed is the role of the compliance officer, the role of the client, and the role of the regulator. Historically, Neil would have said, I want to invest here, and questions about suitability for that particular fund structure. If a compliance officer had challenged that question, you can imagine the short thrift he would have received. It would probably have been career limiting. A successful fund manager would have challenged him and said, actually, no, chief exec, trust me, this is a core part of our business. And the compliance officer would have been overridden. That balance and power has shifted dramatically. There is pressures in the UK context, we call it TCF, treating customers fairly. It's about suitability. It's making sure that underlying liquidity profiles of fund structures match the liquidity profiles of funds. And fund managers doing exactly what they are supposed to do. So there's been a big move to address that mismatch. That's changed the power of the compliance officer. It's meant much more aggressive oversight from risk officers. And it's also meant that the fund manager can't override. If you get this wrong, it's career limiting for the compliance officer, the risk officer, the chief exec, and the fund manager. I think Neil's just found that an incredibly stifling environment. So he's left to set up on his own in a freer environment with a more appropriate mandate set. And I think that tells a very interesting story around structurally why at this end of the market you get some of the kind of returns Ryan was alluding to, that while there's an ebb and flow in appetite, in risk appetite for smaller microcap companies, structurally there are fewer and fewer players who are able to invest long term at this part of the asset class.
Perfect. Thank you very much. So AIM now is about 1,100 and was something like 1,600, I guess. Okay, Brian, would you like to kick off with the U.S.?
Sure, thanks. So thanks to Steve and Ryan. It's a real honor to be sitting before you today. The microcap space in the U.S. It actually tells a little bit different story. Sarbanes-Oxley has actually reduced the number of opportunities in this space. Private equity activity and public equity takeovers have actually contributed to that. When I started my firm in June of 2000, the CRISP data set, which for those of you who are unfamiliar with that, is the Center for Research and Securities Prices, which is actually input data for Ibbotson that Ryan referred to. CRISP tracked about 6,000 public companies in the U.S. in June of 2000. Today that number is less than 3,500. So that's a pretty substantial shrinkage. And the majority of that is obviously happening at the smallest level. Sarbanes-Oxley has made it pretty unpalatable for the $20 and $30 million market cap companies to remain public. And so our universe has shrunk, but most of that activity has actually left in an area that even for asset-limited managers like us, we weren't playing in that smallest strata anyway. So what CRISP does is they segment the U.S. market cap universe into deciles, and so it's a little complicated. So if you bear with me for just a second, what they'll do is they'll slot in all the companies that are listed on the New York Stock Exchange in any given year, and they will make equal numbered deciles, and then they will add to the deciles where names are listed on the Amex, the NASDAQ, and most recently Archipelago and the alternative ECNs, and they will populate mostly the smaller deciles. So what you have is more numerous deciles in, say, the 9th and 10th, the smallest 20% of the U.S. stock market, and than you have in the top 20%. And the returns that Ryan were alluding to, but since 1926, the 9th and 10th deciles basically provided between a 2 and 3% annualized compounded advantage over the top 20%. And so that's sort of a microcap tailwind. And the largest name in the 9th decile, when I started the firm, was about 200 million, and it just happened to coincide with the smallest name in the Russell 3000. And so when I started Bears Capital, I thought, well, a lot of allocators are benchmarked to the Russell 3000. But they don't realize that there are another 3,000 companies below the Russell 3000, and that's a fertile playing ground that provides a natural 2 to 3% tailwind, and so there should be participation in this space. But even more interesting is that advantage is prevalent despite some structural disadvantages of microcap stocks, including reverse survivorship bias, where successful names in the space graduate out. And there are graveyard effects where it's kind of a space where small companies go to die. So failing companies going through bankruptcy populate the space as well. So applying just a modicum of active management can actually improve those returns significantly. But what's interesting is today the number of public companies tracked by CRSP is about 3,500, which represents about a 40% decline. And the number of opportunities is actually relatively speaking, let's call it 1,100 companies below 200 million. But the top number, or the top market cap in the 9th decile is currently 775 million. So the definition of microcap has expanded up the market cap spectrum significantly. We haven't adjusted our market cap that high, but it's becoming larger by market cap and less numerous. But the flip side is that the companies that couldn't afford to be public are gone, and so you have a bit more legitimacy in the names that are left.
Great. And Tom, your perspective from I neglected to mention that the liquidity structures each of these managers have are slightly different. Brian runs separate accounts. Tom has a private equity classic structure, I would say. Adam's microcap fund has a 3-year term and annual liquidity. So your perspective?
Yeah, there's the CRSP definition, which is quite complicated. Or if you really want a very simple rule of thumb for what a microcap is, what I'd suggest is if you gather all of the small companies you can find, all of the smallest ones you can find, and when they add up to about 2% of the overall market cap of the United States, those are the ones that are market caps. If you look at the CRSP definition over the last 10 years, what you'll find is although it probably varies from at its lowest around $400 million and less to its highest or nearly $700 million and less. A second simple rule of thumb for you is there are companies that are $500 million or less, or the bottom 2% in market capitalization of the United States. Then the question is, how many of them are there out there? Well, it really depends on whether you want to look at the United States and Canada and what you really want to consider a public market and what you want to consider a publicly traded company. So at the small end, I'd say that, and I think what Ibbotson and CRSP do is they use a pretty narrow definition of that which is public. There's probably about 1,700 of them. At the high end, if you really stretch the definition, there's nearly 8,000 of them. So if you want to look at the microcap sector, you can say basically it is somewhere between 50 and 80% of all publicly traded companies, and they constitute the bottom 2% of market capitalization. What Millroad focuses on is the value end of the microcap market. And I think you make a mistake by considering microcaps as one asset class. They're really two fundamentally different asset classes. Microcap value has a low beta. Microcap growth has a high beta. Microcap value has low liquidity. Microcap growth has high liquidity. The companies have different holders, different liquidity structures, different ownership structures. Microcap value, for instance, is very, very, very largely retail. Microcap growth has a much higher component of institutional ownership. So one thing, as we look at this very large asset class, is really to try to remember that it's not really one asset class, but it's two.
Great. So now back to the normal program. We're going to have each of the speakers talk for 12 to 14 minutes about their approach and color it with a lot of interesting examples. So, Brian?
So my story is a little bit different than what you probably normally hear on this panel. I've never worked on Wall Street. From the Midwest, I grew up in Omaha, and I have my firm in Austin, Texas. And I was working for a small boutique, small value manager in Austin, and I noticed that there was a lack of allocation on the part of institutions to the microcap space. And when I was contemplating starting my firm, I really had a passion for this idea that we should remove agency issues and just try and structure an investment strategy that would maximize compounding over time. And as a sub-manager for institutions, microcap didn't really fit the traditional Morningstar style box view of the world, where you had to fit neatly into value blend growth or small, mid, large. And we, when I started Bears Capital, made the conscious decision to go to primarily the endowment and foundation community, where there were less sort of marketing intermediaries and fewer, frankly, check boxes for, assets under management that would allow us to, garner an institutional client base from day one. And, we had a meeting with Cambridge Associates, and they were loath to take the meeting because we didn't have the AUM required of a manager of theirs. And I asked what that was, and it was larger than the amount of capital that we were trying to raise. And so we have had a sort of a problem, and so the way we solved it was going direct to allocators that were a bit more forward-thinking about their ability to put capital in emerging managers, frankly. But the recipe of the inefficiency combined with a fairly concentrated approach, we have 10 stocks per portfolio. We run 2 institutionally focused strategies that are both closed, so this isn't a commercial. But we have $400 million roughly in AUM in our concentrated microcap strategy and about $870 million in our concentrated small cap strategy, both with 10 stocks. And it really is a combination of best ideas combined with inefficiency, and that should produce sustained compounding in excess of market averages over time. And over our 14-year history, that's been vetted out. But the interesting part about it is that we don't do any quantitative filtering or screening in what is, as Tom described, a very numerous opportunity set. And the reason for that is that our belief is that internal compounding of business value drives stock prices over time. And so if we are looking for above average stock price performance, we necessarily need to be looking for above average internal compounding of business value. And microeconomic theory would dictate that in an environment of pure competition, you cannot out-earn your cost of capital over time unless you're in a competitively advantaged position. And so we seek out the qualitative factors that would describe competitive advantage within a business and management capability, not in terms of just the Buffett sort of great capital allocator approach, but also excellent operators and executors. And so we have a team of 11 people in Austin, 9 of whom have the title of research analyst, including myself, and we fly around the country cataloging the qualitative aspects of the smallest companies in the U.S. Stock market. And I think over 14 years, I'm not over-promising anything by saying that we, I think, have the premier database in the United States of that qualitative information on a relatively undercovered and sometimes uncovered space. And so the problem with microcaps is you have to do your own work. There are structural inefficiencies that exist primarily because there's a lack of participation on the behalf of large institutional investors in the space. There's no investment banking business. There's very little in trading volumes and commissions for the big banks. What you have to do is you have to go out and kick the tires yourself, read 10Ks, 10Qs, go meet with management, walk trade show floors, do the sort of boots on the ground research that that everybody sort of gets into the business to do. But the big problem is that our peers on the buy side don't have the resources as a startup to replicate the work that we're doing. And by the time they have those resources, they tend to follow their economic incentives up and out of the space where professional competition becomes much more intense. They graduate into mid and large caps where they subject themselves to the typical investment manager life cycle. And the ones that try to remain in the space tend to over-diversify to accommodate a much larger asset base. And so we've solved for this by essentially making this compromise and giving money back to our investors and staying sized appropriately for the space. And so we've given money back twice in our history, and we're about to do it again in a couple of months. But the idea is to make the train as fast as possible and not as long as possible. And it's difficult. It's a difficult compromise in microcaps because the advantages are fairly numerous. We can get close to companies in a way that's just not possible in the large cap space. And when I say close to companies, I don't mean, access to material non-public information, although that's occasionally happening where we have to restrict ourselves in names because we hear things that we don't, or the CEO or CFO is not Reg FD educated. But what I'm really talking about is just the ability to spend time with a founder, owner, operator of a very small company whose life's work has manifested itself in terms of a $200 or $300 million company. And you get to spend all afternoon or all day with this person who walks the factory floor with you, spends time on their history, their decision making, and you can get a real feel for the potential value creation of a company in a way that's just not possible when you have kind of an IR intermediary in a large cap format where you're sitting with 20 or 25 other investors and attorneys are present in the room and that sort of thing. So I guess the punctuation mark to all this is it's a blast. I mean, we have a wonderful job where we're treasure hunting all day in the smallest companies, and we have situations where in one case we own a company in Pennsylvania where we were the second and third analyst to ever visit the company, and they had been public for 10 years. So it's we have situations like that where you can sort of come back to the office and say, I really don't think other people understand this company, and it's just for a lack of trying. So.
Okay, I'm tempted to ask you for an example if you're ready to share one of those stories, whether you're in the stock now or not, walking the floor, getting to know it. Just a good example of one of the companies that you've worked with over the last 14 years.
One of our current portfolio positions, and I'm not standard disclaimer, do your own homework on this one, is a maker of flexible gas pipe in Pennsylvania, and it's not it sounds like the least competitively advantaged business on the planet, a domestic manufacturer that's bending metal pipe, but the operating margins are net operating margins are 20+%, returns on capital 30-40% year after year after year. And the secret sauce they have, and you're going to laugh when I say this, and I laughed when I heard it, is actually a black box. And so it's a black box where there's a proprietary, trade secreted, not patented, so that the process is not out there in the public domain, rotational process that creates corrugated metal pipe in a way that does not heat or cool the pipe, which is important because when you heat and cool steel pipe, it reduces its structural integrity, which means that if you drive over it with a truck, it'll break. This company's metal pipe doesn't do that, and it's replacing traditional black iron pipe in residential and commercial applications where a plumber that's in his 50s or 60s is used to getting around corners within a building by putting joints in and doing a lot of welding and that sort of thing. This is flexible and corrugated. You can pull it through, around corners through an office. And younger plumbers are trained on this particular product. And it went from 0% of the market 15 years ago to now over 60%. It's on its way to becoming a basic monopoly in the space for some technical reasons. But the proprietary manufacturing process is one where steel goes in one side of a black box and comes out a fully formed corrugated metal pipe on the other side. And they will not tell you what's in the black box. There are 3 people that know. And it's a phenomenal little story. And I had 2 analysts come back and say, you have to see this to believe it. And it's true. And when I hear an analyst on our team say, you have to see this process to believe it, or you have to meet this person, I know we're onto something. Because that's a variant perception that other people can't get from reading 10Qs and 10Ks. And if you read a description of this company on a simple Yahoo profile, you would never get a feel for how special it is.
It's 6-inch Lilliputians in the box.
That's right.
Thank you very much. Tom, would you like to carry on?
Yeah, sure. What I'd like to do, since we have very little time for these presentations, is make 3 basic points to you. The first is that microcaps are a very attractive asset class. They should be part of your portfolio. The second point I'd make is that it's a class that is exceptionally conducive to creating alpha. And the third is, despite all those positive characteristics, there are very few and very safe options in terms of structured pools for you to invest in. So we began a few minutes ago by defining the size of the asset class, and whatever you want to choose as a public company. The asset class is somewhere between 2,000 and 8,000 companies. Going to our 90-year database, which we've all cited, depending upon whether you want to use the arithmetic mean or the geometric mean, whatever you choose to measure returns, what is clear is that microcaps outperform the market over a 90-year period by somewhere between 500 and 600 basis points per year. Now, before you get up and quickly run to your broker and say, please buy me a big microcap that's kind of has a lot of liquidity and good growth characteristics, if you were to do that, you'd be making a big mistake. Because most of the outperformance in microcaps can be explained by any one of 2 factors, and then there's also a third factor. The first factor to be aware of is liquidity. If you divide the universe of microcaps into low liquidity and high liquidity, what you find is that low liquidity outperforms high liquidity by, and this isn't a misstatement, by 1,500 basis points per year. If you divide the entire U.S. capital market by size and by liquidity, the worst performing asset class is the small, high liquidity class, and the best performing class is the small, low liquidity class. So low liquidity is a very, very, very important driver of microcap outperformance, and it might explain even over 100% of the outperformance. The second distinction which I began to point out as we introduced the category is value very materially outperforms growth. Now, anyone who studied equities knows value in all asset class outperforms growth, but the outperformance in microcaps is quite significant. If you go from the period from 2000 to 2014, what you'd find is microcap growth returned about 3% a year, the overall market returned about 3% a year, and microcap value returned about 11% a year. So there's also an argument to be made that value explains 100% of the outperformance. The final thing to note about microcaps is that size does matter, and when I say size matters, it's small size that matters. If you divide the microcap universe into pieces, and if you took the top third largest microcaps, maybe they outperform the market by 4 or 5 percentage points a year. If you take the smallest 1/6 of microcaps, they outperform the market. They outperform the market by 1,500 basis points per year, or very, very small microcaps outperform large microcaps by about 10 percentage points a year. So when you look at this microcap phenomenon, the first thing to remember is that we have a number of different asset classes, and what really seems to explain microcap outperformance is low liquidity, value, and exceptionally small size. Now, when it comes to opportunities to create value, now you have an asset class that's materially outperforming the basic market index. I'd say this asset class has 4 characteristics that make it exceptionally conducive to creating alpha. The first is valuation. Microcaps are historically, every study I've seen over the last 30 years, they are valued less than the overall market. If we took a cut right now, what we would say is we would see that 30% of all publicly traded microcaps trade at 8 times EBITDA or less, while 15% of the overall rest of the market trades at 8 times EBITDA or less. So first, if you're looking for alpha, they're a very good pool to fish in because their valuation is quite low. Second thing I'd say about them is that the standard deviation around the mean of fair value is actually quite broad, much broader than it is in larger securities. The reason that standard deviation is large is really rooted, I believe, in 2 factors. The first is these companies have little or no institutional coverage. The average microcap has maybe 1 investment banking analyst. The average large cap has 20, 25 investment banking analysts. So there's poor information. The second thing I'd note is that these securities are disproportionately held by retail investors. While retail investors maybe hold 15-ish% of overall securities in the U.S. equity markets, you're probably around 70% of microcaps. So what that means is the marginal price-setting buyer in microcaps is an unsophisticated and fairly uninformed retail buyer, and that creates a wide standard deviation around what fair value is, which is also great for alpha creation. Third point I'd make about them in these 4 characteristics is that these securities are marked by poor guardianship. And by poor guardianship, I mean 2 things. First of all, if you look at the boards of directors of the companies, they're generally unsophisticated and modestly disengaged people. So you don't have a very strong agent for shareholder value operating the companies. The second thing I tell you is that these companies really do operate below the radar screen, so they can get away with a lot that other companies can't. I can give you one quick example, which is actually the first time my son ever heard me say the F word, which was on Christmas Eve when one of our portfolio companies, the CEO decided to sell cheap stock to his father on Christmas Eve. That you generally wouldn't see that at ExxonMobil. I don't think. So there are a lot of low-valued companies. There's wide standard deviation around fair value. They're marked by a lack of guardianship. And the first thing I'd say to you is that there are heavy costs for being public. If you were a microcap company 15 years ago, it cost you $500,000 to be a publicly traded company. If you're a microcap today, it probably costs you $2.5 million, which means if you're making $25 million in EBITDA, 10% of your EBITDA is being spent on being a public company. The second thing I would point to is that there are a set of dysfunctional, localized public market incentives, which means that companies do things in the public markets that they wouldn't do if they were private. I could give you a long list of them, but probably the most powerful one of those is there is a very, very strong motivation to maximize revenue among publicly traded microcaps. Why do you want to maximize revenue instead of return on invested capital? You want to maximize revenue because you can grow out of your microcap discount if you maximize revenue. And if you decide to do something to diminish revenues, there's no investment banking analyst to explain to anyone that it makes sense. So I'll give you an example. Years ago, I looked at a company called Au Bon Pain. You might know it. It had 110 restaurants. 30 of them were losing money. All of those 30 restaurants could get out of their lease at no cost, but they wouldn't close any of them. Why wouldn't they? Because if you lost 25% of your revenue in 1 year, you would be consigned to being a microcap forever. So, that should be a really good opportunity for private equity. So if you go through those four characteristics, I think what you see is you would see that this is an exceptionally rich sector for creating alpha. Now, the question is, if it's an asset class that beats the overall market on an index basis, and it's a strong, it's a very great asset class for creating alpha, how do you exploit it? Well, there are a couple of ways you can exploit it. There are index funds. There are two that probably have liquidity that would meet your needs. One of them is the iShares Microcap Index. It's an ETF. It trades about 150,000 shares a day. So if you're looking to get index performance, that makes sense. There's also mutual fund, the DFA 910, which is the intellectual leaders of that are French and Fam. It's kind of a smart index fund, so you could get a little bit of those advantages in terms of liquidity and value that you wouldn't otherwise get. If you're looking to invest in a mutual fund, you have a problem if you're looking at microcaps. If you go into the Morningstar database any time over the last decade, what you'd find is there are about 40 microcap mutual funds. Microcap in that they have microcap in their name. If you look at what their portfolio constitution is, you'll find that maybe one or two of those at most have more than 50% of their assets in microcaps. There are a couple of really basic reasons for that. If you're a good microcap manager, what happens is you collect assets. As you collect assets, you have so many assets that you can no longer invest in microcaps, so you redefine what a microcap is. The other is actually minimum scale is for running a mutual fund is quite high, and because it's quite high, it's really not an economically efficient instrument to invest in microcaps. So it's very hard to find a mutual fund that will focus on microcaps over an extended period of time. With hedge funds, I think that there are two problems that you have if you want to invest in a microcap hedge fund. There are, anywhere from 15 to 50 of them out there. The first fundamental problem with the microcap hedge funds is there's a misalignment of incentives, and by that I mean it's very easy if you are ethically challenged to run a microcap hedge fund, where as you aggregate assets, you invest in single securities, you drive the price of those securities up because they're illiquid. As you drive the price of those securities up, you have good returns, you generate more assets, you drive the price of more securities up, and you take a very large incentive fee. One thing we see is usually, I don't usually do much of the trading in my firm, but people go away around Christmas, and I do it on New Year's Eve, and you'll find an extraordinary number of really odd trades in the last hour before the market closes on New Year's Eve. The second thing I'd say, a problem with investing in microcaps and hedge funds is there's something of a liquidity mismatch, and you saw that in 2008, 2009. What happens is when you have redemptions, those redemptions in the microcap hedge fund drive the selling of the microcap securities, and you end up with this downward liquidity spiral. So microcap hedge funds, if they don't have the right liquidity structure, are a fairly risky asset to invest in a down market. So my conclusion to you really is it's a very attractive asset class. It's an asset class very conducive to creating value. There are index funds you can capture much of that value in, but if you're looking to create alpha outside of an index fund, you just have to be extraordinarily careful in doing your due diligence before you invest in those instruments.
That was excellent. Thank you, Tom. I know these guys, because they're moneymakers in this small space, are loath to talk too much about their process. But if I could tease out a little bit more on your approach, how you do it given these characteristics, and then an example of a successful investment you've made.
Yeah, I mean, the first thing I'd say is I just look at what our structure is. We're not subject to the liquidity spiral because we're structured as a private equity fund, so there are no forced redemptions for us. And we have no incentive to push the share price up because we are actually only compensated on realizations, not on marks. What our process is over a 5-year period, what we'll do is we'll take small positions in about 80 microcap securities. Maybe we'll have 30 at any given time. Small ones will be a couple $100,000. What we then do is we use that as a calling card for management. And one of the things my colleagues on each side of us will smile when I say this is about a $400,000 investment often makes you the second or third largest institutional investor in these companies. So you're a pretty important person when you show up. Of those 80 toehold investments, if our thesis is validated, if the share price doesn't go up a lot, we develop about 40 strategic blocks. That means now we are the first or second largest shareholder. We own 5 to 20% of the company. We meet with the company 10, 12 times a year, and about 1 in 7 of those we do some sort of transaction ultimately with. We take them private or we do some sort of structured transaction. One of the interesting phenomena, and I'll tell you all, is that is over the course of our first fund, we met with about 150 CEOs, and of those 150 CEOs, there were only 2 who said to us that they think it really makes sense for them to be a public company.
Interesting. Great. Okay. Adam, you're still awake down there?
I'm wide awake.
Okay.
I'm rapidly rewriting what I was in my head, what I was about to say, given not least, and Thomas won't mind me saying this, I think I should probably put a little bit of a defence in straight away for hedge funds in the microcap space. Thomas is absolutely right on that front around liquidity structures, incentives and behaviours, and that's something when you sit down with a hedge fund manager in the microcap space you should really try and test. We run in our core franchises 3 product areas. We run a hedge fund. The issues we faced with a hedge fund which was launched in 2002 was that we felt in the pressure to preserve capital, to retain low volatility, which feels like a bit of an anathema in this space. We felt very often we were selling stocks too early. And really, the objective of investing in smaller microcap names is capturing the return to be had from a lack of liquidity and investing long when others don't. So we set up in 2006 a conviction fund to take on that volatility, to take on that liquidity risk, and to reflect the conviction positions that we really wanted to own for the long term, in very similar styles in many ways to the way Brian and Thomas have talked. And more recently, we've done the same again to go microcap, real microcap, sub 100 million, because we felt we were missing out on opportunities where we would like to have deployed more capital, but we didn't feel we had the right fund structures to do so, the right liquidity profiles to do so. Just on that hedge fund front, I think the one thing I would really like to pull out, apart from some of the general trends, is that we are all taught as investors to buy. We're trained, we're tuned, we want to believe, we want to listen to stories, and microcap investing is about stories. The worst discipline amongst all investors, I think, is self-discipline. My own is worst discipline, self-discipline. My colleagues' worst discipline, self-discipline. I think running a hedge fund teaches you something different. You sit down with a company and something doesn't quite smell right. If you run long-only money, you just disregard that. You move on. You look to the next thing. If you run short money, you think, what's not right about that? There's an incentive to go and explore what's wrong with the business, whether it's a management quality issue, whether it's a business model issue, and to explore the balance sheet issues, to explore the consequences of that, the likelihood of failure, to understand better whether forecasts are well calibrated, whether these can be articulated well to a broader market. Now, out of that, I think my team back in London, I think our long-only stock selection is vastly enhanced, because the consequence is clearly you're more attuned to the things that may go wrong. So I'm just throwing that in. I hadn't planned to talk to that, but I'm just throwing that in as my little defence of the hedge fund approach in this asset class. A lot of what I've got to say chimes a lot with the way Brian and Thomas have talked. If there were 3 takeaways I would like to leave you with today, there would be around opportunity set. I'm going to talk in a second. Thomas said it at the outset. This is an opportunity set. It's not an asset class, and I think it's very important we frame the debate in those terms. I like what Thomas said about liquidity. This is an asset class for patience. Liquidity is the lack of liquidity in this space is your friend. If you haven't got patience and the time and the wherewithal to stay long in this space, the lack of liquidity is your enemy. And I think that's why the data that everyone's talked to has produced fantastic returns, and why there's an opportunity a great opportunity for alpha structurally in this space. And lastly, again, stewardship, guardianship, those kind of issues. I'd like to talk a little bit about the responsibilities of fund managers to engage with the companies in which they invest. Brian's talked specifically to qualitative issues, returns on capital effectively, sustainability, the nature of engagement to make sure that business managers focus on shareholder value creation when the incentives in public markets are often contrarian to that. So just to start with, briefly on opportunity set. The framing is so important. If we talk about this space as an asset class, it invites the wrong questions. We start thinking about market timing. We start thinking about economic cycles. Now, unfortunately, at this end of the market, the opportunities don't present themselves at the times when those who think top-down is a good time to invest in this asset class. I shouldn't say asset class. I'm going to try and stick to opportunity set. What we're all trying to capture is what we would call the small cap effect. Now, you can attack that in different ways and different processes, but in essence, it's 2 things. On the one hand, it's a huge gap between a market perception of a business and the business reality. That's what we're all looking for in our engagement with the companies to try and understand. That perception can be value-driven, or that perception can be driven around the debates surrounding an industry or a company. Understanding those and identifying a business reality that's a significant gap will realise in time a significant return in the investments you make. The other way of cutting that is to say you're looking for a scale of change. If you can identify, we're probably a bit more agnostic about the difference between value and growth, but if you can identify a scale of change within a company, and typically it's not rocket science to say it's easier for there to be a greater scale of change in a small company than it is in a large company. So by definition, if you can capture that scale of change, identify that scale of change qualitatively, as Brian talks to, you've got a great opportunity to make a return. Now, if I give you just Ryan loves examples. I'm just going to give you a couple of examples. I think in many ways, so this is about the timing and the top-down asset class debates rather than the bottom-up stock-specific approach. I think in many ways our job is to wander around the world looking for what I describe as a drunk's rare moment of clarity. We'll do, and some investors find this unpalatable, we'll do 800 to 1,000 meetings a year with companies. That's part of our sifting process. But in engaging in that debate, what we're doing is just trying to listen, just trying to be attuned to find a couple of investments a month that are worth really exploring in depth. I'm going to pull 2 out as examples. In 2003-04, there was everybody's familiar with Bluetooth today. In 2003-04, CSR listed on the UK market. Sometimes you get to the right conclusion in an unusual way. The big debate, it was too soon really for that kind of business to come back to market. Everyone was still scarred by the hyperbole surrounding the failure of the whole .com boom. So the conversation I was having with the CSR management is, why on earth do you want to put your head above the parapet? The consequences of failure being in a public market are so much greater than doing this in a private capacity. What on earth really makes you believe that this is happening now? When did you believe this was going to happen? And he responded, he said, October the 17th. In that instance, I knew that Bluetooth was happening. Everybody in the industry was debating about whether 802.11/B was the right standard or not. It was, so there was a technical debate going on that just wasn't relevant. The market carried all the emotional baggage of .com. If you're looking at this top down, you're not going anywhere near this business. He was so spuriously accurate about when he actually believed. It wasn't for him concept. It wasn't for him rhetoric anymore. And it was simply because he'd been into the main our equivalent in the UK of Best Buy is Dixon's. He'd been into Dixon's store and he'd asked the assistant behind the desk which phones were selling, and they came back and said, a bit Intel inside, only those that have got Bluetooth on them. In that instant, he believed. And so, those are the drunks. That's our job, looking for that little drunk's rare moment of clarity that shines, and that's the trigger then to go and explore in more detail some more substantive and proper DD around the business. If I roll back the clock, we're all going to have war stories. We're all going to have great investments, particularly from 2009 because of where the market was in that moment. But let me talk you through how you reach a decision without making a market call, without thinking top down, but thinking exclusively bottom up. Business called Spring Group in the UK. IT recruitment. We all think the world's going to hell in a handbasket. Everything's telling you from the top down that growth is gone. Why on earth do you want to invest in a staffing company? Well, two things happened, qualitatively and quantitatively. Qualitatively, Barclays Bank announced in February 2009 that they were planning on recruiting 600 IT engineers. What on earth's going on there? That's completely contrarian to the wider debates. The fact is that Barclays' IT systems were going to fall over faster than it ran out of capital as we were coming out of the credit cycle. They needed to address that issue. Qualitatively, tick. Quantitatively, and markets, and I'm sure that both the gentlemen are right, will agree with this, markets generally look at earnings. They don't look at cash flow, they don't look at balance sheet, and they don't measure quality of return or market position. In this particular case, we had a business with a £20 million market cap, with £20 million cash on balance sheet, a distressed seller, wrong investor, wrong fund structure in the microcap space, and a £20 million debtor book. If that business was shut down, the existing staff that it was employing, the revenue that came off from them, would have paid back 40 million quid within the next 9 months. You couldn't help yourself but buy that stock. And yet you would have a debate with the market, and the market would be saying, no, but the earnings are going back. I don't know where the earnings are going. I know this is the wrong price. I know it might become an even wronger price. That's awful English, I apologise. But that, you can't help but get excited about that. Before you even get to the question, actually this is a long-term franchise. This is a business that is a going concern, will be here. And very often in this space, trade will move faster than markets. It was 9 months later this was taken out by 60 million by one of the largest European staffing companies. So I think that tension between bottom up, you have to be in this game for the long term to be able to make those kind of decisions. So that brings me on to probably the second point around patience. There's a lot to be said about reward in this game. Patience is incredibly important. I think you get this is an asset class that clearly demands patience, but I think you rewarded disproportionately for patience when you make investments. You can't always control when you're going to get a realisation or secure a return. So you have to be patient, and when committing capital to this space, you've got to have that at the forefront of mind. But interestingly, around that, if you find an investment manager with patient capital, what tends to happen is they can invest in companies and give companies certainty of duration. And one of the strongest features, I think, of this market for the last 6 or 7 years is that when we're investing, we're looking particularly for company position. That probably chimes a lot with Brian's observations. It's more obvious who wins in many sectors than it has been in any other cycle, I think. And those companies win disproportionately. It's difficult sometimes to forecast sales, particularly in some of the more cyclical industries. It's less difficult to forecast market share gain because there are qualitative drivers behind that. 2009-10, that was about balance sheet strength, but actually it's about far more than that. It's about market position, it's about service delivery levels, it's about the extent to which a business is well invested, the extent to which it has stayed investing through tough times. And companies that have access to patient capital can make those decisions. So success in that respect breeds success. And the final part on the reward return part of that equation is when you've got investors who've been playing this game, and I agree with Thomas, there's a great tendency to move away from this space as a fund manager because the returns can be very lucrative from managing more money. So you don't have certainly in our world, it sounds like very much in the US too, you don't have investment managers or professionals who have been through a number of cycles in this asset class. When you find one of those, it's usually because they've been successful. The other side of that is when the times are tougher, they're the first call. They're the port of call for companies because they know that they're going to be able to raise money or be supported. And in the last year or so, for example, I think there's a debate perhaps they had about where we are in the IPO cycle today. But one of the things we've been doing in the last year or so is participating more IPOs than we have done historically. But that's because we can be the cornerstone. In order for deals to happen, because of risk aversion, because some certainty is required that a deal is possible, a public listing is possible, you need a pre-market, you need a relationship with a fund manager for some time ahead of that in order to be sure it's going to go to an IPO gets away. So for those that you find attractive or we find attractive, there is an advantage from having been in the game. You get presented with opportunities that aren't there for others. So just to finish off on the patients, I think it's very important to think about the structure of funds. And I'm going to throw these issues out as questions really. I think as investors going into this space, you should think about liquidity. You want to be sure that in the first instance fund management behaviour matches the rhetoric. You should be looking at not investment horizons, but looking at holding periods, duration. Do we do exactly as we say? That's the first criteria. I think fund structures are incredibly important. The 2008-9 experience was very cathartic for the industry in the mismatch of liquidity profile of the underlying asset and the underlying investor. So it's very important to make sure those fund structures are defined in appropriate to the asset class. The fee incentive structures, I think that's central to that. Make sure there aren't disincentives in this process. With our new Catalyst product, which we launched in May, there is a P fee attached to it, but that's entirely back-end loaded. The P fee is not taken until the realisations are taken and the money's been handed back to the clients. So the patience part of the equation that I'd like you to take home is to think about the liquidity, and the point about liquidity is the lack of it is your friend if you've got patience and duration. And if you lose control of your destiny or the lack of impatience, you need to think about who you're invested alongside. I'll just share one little anecdote. It's sometimes worth asking fund managers how often they turn down money, and the circumstances in which they turn down money. This is a relationship game. If you want to play this game for a long time, you need a relationship with your underlying clients. We had an opportunity to take 30 million in from a client who will remain nameless in the smaller micro-cap asset space in 2007. It was one of the most extraordinary meetings I've ever had. It was in a beautiful, beautiful old building in London, one of the best offices, studies, a library, and in amongst the library, a huge, great dining room table, piled with papers, Bloomberg TV, full screen, about the size of this behind us. You walk in, a guy who had great presence, lovely silk shirt, and sat with his back to us at his desk, 3 or 4 screens in front of him. So all the instincts are telling you he's thinking about the here and now, the fast. This is probably not going to be the right asset class for him. When he turned round, he had his Oakleys on, and I don't mean sunglasses. I mean he had full Monty ski goggles on, quite literally. And there was red all over the screens, and he turned around and said, I'm trying to look at the markets through rose-tinted glasses. There are a whole variety of other reasons why he wasn't the right fit. But the important part of that equation is that it's important that we choose who we invest with as much as you choose who you invest with. And investors need to get comfortable with either the fund structure or who they are invested alongside with a PM, to make sure that the PM doesn't lose control of the fund because of either impatience or an investor who loses control of their own destiny.
Adam,
I've gone on too long.
No. Remember where you are. I saw Tom nodding his head. You were talking about first port of call after a difficult period. And then you also talked about the ability to do rights offerings and things, or alluded to it. Tom, what's your take on that?
I was nodding my head. I mean, in 2008 and 2009, we were and my firm was in an extraordinarily strong position because we had no redemptions, and so we really became the first call for every fund that was redeeming capital. And so, matching fund structure to this security structure is really important. And I know many of you don't like lockups, but it is exceptionally difficult to say to a manager, I am investing in you because I want you to be patient for 4 years, but I want to be able to take out my capital every month over that 4-year period. And that's the structure that really led to massive collapse in the sector in 08-09.
Lockups are a dirty word for many investors, and the dirtier the word is in that conversation, the more likely that they're they've not necessarily got the commitment to the asset class that they really need to capture the return opportunity that's there.
Maybe just on the ability that you have at Henderson to back a management team that's either had difficulty or a management team that's looking to expand, build a new business. I'd love an example, if you wouldn't mind, of a case where someone came to you and said, here's this adjoining business, this is the capital we need, this is our business plan. That's sort of a discussion.
My favourite example of that is a little business called IMAR. It's rolling back the clock a little bit. It was an investment we initially made in 2006. Again, I think where we're very often strongest is when someone at the coalface is starting to scream, and in much the way an analyst comes in and starts thumping the table, you've got to look at this, you've got to look at this. In this case, it was a management team that came and said, you've got to look at this, you've got to look at this. Everyone was still tarnished by the history around data centres. This was a data centre play. It was a former dot-com darling. It had a handful of other businesses attached, and it was able to pick off from British Telecom a mothballed data centre for £5 million. It was utterly the wrong price. Now, there was no revenue in that, but we could see at that stage that the market was turning. You could see that everything that we'd been expecting in 2000 was starting to happen in terms of data consumption, particularly from enterprises, less so yet from mobile consumption, etc., but particularly from enterprises. And the outsourcing dynamic was emerging from the banking system, because data centres are capital intensive. And these guys just needed some capital. So we obviously did quite a lot of due diligence on this space, decided to commit the capital. We also shifted the remuneration structures. There's an important point to make about being actively engaged. Shifted the remuneration structures to align them with our objectives for creating shareholder value. And that involved the sale and disposal of 2 businesses. Now, I think I forget which one of the 2 of you mentioned it, in terms of disincentives. This was a company that needed to shrink to grow. And it was something they felt decidedly uncomfortable selling a revenue-generating, cash flow-generating business in public markets to be left with a data centre that needed building out. And yet, put on the spot, they were very comfortable saying, we think this business has less revenue tomorrow, the year after, less cash generative. So we go back to them and say, look, if you don't sell that now, it's going to wither on the vine. You're going to sell it later at a lower price. Having a substantive, committed investor saying this is the right thing to do to create shareholder value gave them the confidence and the wherewithal in public markets not to worry about the share price implications and the articulation of this action to the broader market. That business traded variously between 27 and 50p through 2007, 2008, and then slowly the market started coming to them. Last week, we don't own the stock anymore. Last week that stock was trading at £2.80 and has on a multiple of 10, 11 times EBITDA. It's more than delivered on its objectives. But being focused has then opened up, and delivering has opened up access to capital to build and add to that data center capability.
Thank you. So we've got just 3 or 4 or 5 minutes. I haven't heard the great story from Brian in terms of a name that you've invested in. And last night we were talking. You said I buy small companies that I want to be large companies. So just one of your ringing successes and how you played it, how you got to know the management team, if you wouldn't mind. And don't feel bashful about a ringing success.
Okay. So actually, I think we were sitting. I don't know, it was you or Steve that said last night. So basically, your strategy is buy really small companies that get really big. And I was like, yeah, that should be our marketing line from now on. I mean, that's basically what we're trying to do. I think I wallowed around for a long time in my early career trying to find niche little companies that didn't have the growth implicit but had great management teams and high returns on invested capital, and they were moderate successes, but I think the returns that we have seen have largely been powered by the really small companies that have gotten really big. And the advantage there is you have liquidity that's really, really small in the beginning, but when they're added to the Russell 3000 and all of a sudden institutional investors start paying attention, the exit is really simple. And by the way, we don't stay in the microcap space once we buy. We obey a certain market caps limitation when we're purchasing, but obviously we want these companies to grow much larger, and so we don't subject ourselves to the same reverse survivorship bias that the index is subjected to. But to your point, probably our biggest success has been a company called Stratasys, which is all over the newspaper now. It's a company that was early in 3D printing. And it was led by a guy named Scott Crump, who was a pioneer in this regard. He invented a process called fused deposition modeling, which is now the core technology that's off patent, that's used by just about every hobbyist 3D printer that you can buy. My wife bought me a MakerBot for Christmas, which tells you the sort of geek that I am. But I have a 3D printer sitting next to my computer at home, and my kids print out toys that we make ourselves on my iPad. And so it's really, really fun. And I have sort of a scientific interest in the technology as well. But the economic model was really attractive in the early days in that Scott designed a 3D printer that was largely developed for prototyping. And so a CAD engineer would be sitting at his desk, and the old way of doing business was, let's say you worked at a Nokia and you were designing a new cell phone case. You would design it in CAD and then send it out to a service bureau, and it would be machine milled or injection molded. You'd have the prototype come back to you a week later. Then you could have something that you could show, design team or your bosses at Nokia. And rapid prototyping was a technology that through 3D printing compressed that time period to 10 to 15 minutes. And so you could have a computer hooked up to a 3D printer. You could design something in CAD, and you could press print. You could leave, go get lunch, you'd come back, and you'd have your cell phone case printed out for you that you could design. And so for functional prototyping, it was sort of the early adopting part of the industry that made it interesting. What we saw and what Scott saw and what is happening now is it's rapid manufacturing applications have really taken off to where end-use parts are being printed from these machines. And so we first got involved with the company when it was $170 million in market cap. Scott Crump is the sort of guy that you just love to fall in love with. He's decided to pay himself less money than he could have because he wanted to set a good example for his employees. He owned a big chunk of stock. He was an engineer by trade, hired a bunch of engineers in the C-suite, which we love to see. His father was an entrepreneur, had multiple businesses that were created and sold for hundreds of millions of dollars. He was on the board. We actually knew a couple of the other board members from a previous investment that we really liked. And so it was just sort of the perfect storm. And the economic model is wonderful because the 3D printers themselves were the razor, but the razor blade was the consumable revenue stream that was essentially the inkjet cartridge to the printer, which is a plastic filament spool that was proprietary and chip-coded to Stratasys. So they were selling into the business market, not the hobbyist market, where consumption is much, much larger, the numbers are bigger, and they honed their reliability. And when I was walking a trade show floor one time, their primary competitor, 3D Systems, who had a competing product, I was walking the trade show floor and talking to users, and they are all saying, we have a Stratasys machine that's running 4 days a week, 8 hours a day, and we never have any problems with it, but we can't get the damn 3D printing machine or 3D Systems machine to work. And I heard that once, and I thought, okay, random data point. And then I talked to more and more people who were confirming the same thing. And it turns out that Stratasys sales started to really balloon. They became the standard in the industry. They had the best sort of fit function for what people wanted. And today it's a $6 billion company, and we sold at $1.5 billion. So that tells you that I'm not the smartest guy in the room, because I should have held on. But that was a huge home run for us, and it was one of the largest positions in the portfolio for many years. But to Adam's point, we bought it in 2003, and the stock flatlined for 4 years. So you have to be patient in order to get the hockey stick inflection point that you're waiting for, especially in names that are growing very quickly.
Great. So I have a couple more, but I'd love to hear from the audience if you have questions.
Do you ever take a management position or a governance on a board position in any of your companies?
Tom, why don't you start?
Either one of you or?
When we acquire a company, we take control of the board. When we do a structured transaction, we always take a board position, and we always really try to be the thought leader in the board. When we have a straightforward public position, typically we don't, because we want to, ultimately our strategy is to acquire as much of the company as cheaply as we can. So we don't really have an interest actually in the public security appreciating that much.
We try to buy things that don't need fixing. So we have not yet, never say never, but we've always filed G positions, and we sometimes own, 15, 16% of the outstanding shares. So clearly we're a voice that, we can wield a little bit of soft power, but we've never taken an active position in a company.
Yeah. And yes, we do. One very quick caveat is, if you ever see a fund manager taking an actual executive or management position, panic. That's not our competency, and that's acts of hubris. That said, if we're taking a position in the company of, say, between 10 and 25% of the public equity, we want to be sure that there's good oversight function. There are occasions when we will have non-execs on the board representing us, and that may be one of a couple of members of our team. Failing that, there's a well connected network of non-execs who think like us, share our values, who we can tap to provide that oversight function. So we're not compromised. What we don't want to be is inside for extended periods unnecessarily. We want to have the maximum ability to trade.
But as you say, there are a number of times where you actually nominate someone that's a friendly party that is very good at the specific business that it's going into.
And occasionally what we'll do is we'll put someone in place for oversight for a very specific issue. So in the example I gave earlier of IMART, Jamie, who works with me, might get very specifically involved just to see, these are entrepreneurs. They've not got skills of corporate finance. They've not got skills of private equity. They've not got skills of handling the sale and purchase of businesses. So if you want somebody to oversee that process where there's a specific competence to bring to the party, that's a good time to put someone on the board for a period of 6 months.
Okay. Peter Lawrence.
This is a somewhat related question, but as I heard all three presentations today, I play in the private equity field, and it strikes me that these are private equity presentations I've just received. You come perilously close to models that are associated with how to attack the private equity marketplace, but it strikes me you come to it with a couple of disadvantages. One is you don't control the ownership of the firm. You don't control the direction of the firm necessarily. You are, to some degree, passive, although I'm hearing a little bit of response to that. Is it a bit frustrating for you to wait for others to recognize the value that you see, number one, and number two, how do you get out of these positions if in fact you can't take enough control to exercise the next transaction?
Well, it's kind of a binary outcome for us where if we're right, and fortunately we've been right more often than we're wrong, the liquidity improves and it's an easy exit. You know, the occasions were not perfect where it's gone the other way. They're true roach motels. It's taken us 6 months to get out of positions before. But the good news is that they are public, and so there's an active market regardless of how the fundamentals are going. I don't know, would you guys add anything to that?
I hope mine sounded like a private equity presentation. A private equity fund, so I'm pleased that got through.
Not frustrated, no, because the opportunity doesn't exist. It's that frustration that puts other investors off. Private equity disciplines to public markets, absolutely. Private equity doesn't like volatility, and so I think sometimes in private equity there's an illusion of control. Investing in public markets, if you've got the right decision and the stock price isn't working for you, it's an opportunity to increase that position. It enhances return. And to your point about exit, I think that's incredibly important, particularly for the fund we've launched in the last year. I didn't talk too much about active engagement. It's incredibly important to make sure there's clarity around strategy on entry, particularly if it's a liquidity event. Not just have a plan A, but a plan B. This is very often a lonely place to be investing. So you've got to have clarity on an exit. The quality of the investment you make, it's no good buying something because it's cheap. It's got to have raison d'etre. It's got to have a market position. It's got to have assets that are valuable to others at some point in the equation. You have to have an agreement with the management team, either reflected in the remuneration structure or in where the natural home of this business might end up. So there are exit plans if they don't materialise onto public markets. But the beauty about this space is equities overreact and underreact. And what we find very often is we get a greater return more often by if you get the initial investment correct, the market will buy into it later and the market will overpay. So when things run, you'll get a higher return than private equity might get in executing a transaction to another private equity or trade buyer. So we don't look for that overreaction, but very often we're a benefit. That's the benefit of public markets.
Brad Palmer.
I'm curious if either of you have employed hedging strategies given the fact that the small and micro-cap market will generally decline more than the broad market in a downturn.
I suspect, having put a defence in case of hedge funds, I'm probably the first person to answer that question.
You're the only one.
Yeah. Three products I articulated earlier. The hedge fund that we run, there is a natural mismatch between the long book and the short book. Inevitably, there is greater liquidity in the short book. You have to have that. Your short book, therefore, tends to be further up the market cap spectrum. There is a mid-cap derivative we use to manage that. But if we have concerns about the broader market environment, our first move is not to try and be clever in shorting the market, it's to take gross off the table. You want to have capital in reserve to play the game when it's tougher and undo the problems other people have. So that's the first observation. That's what we did in 2007 and 8. And the beauty about I must just share this one example because it'll chime. Back to listening. In 2006, a tiny US business called Hayward Williams with a public listing in the UK issued a profit warning. We're paid to listen. We got them in. You're trying to work out what's going on. We got them in, and they said to me, the question is, what's going on in your market? Demand's evaporated. Where are you operating? They said, well, we provide taps, toilets, tiles to something called manufactured housing in the US. I didn't know what manufactured housing was. And when I asked them to explain that, the response I got back was, think trailer trash USA. I hope I'm not causing any offence in here.
None of us have those.
And I said, well, why has demand evaporated? And the answer came back, and bear in mind this is December 2000, the answer came back is subprime financing has gone. So we then had an opportunity to engage in a conversation about what was going on in subprime. It wasn't 2007 April when HSBC, having bought Household Bank in the US, the subprime bank of the US, issued a profit warning. It wasn't until August that year that we had a proper problem in credit markets and Northern Rock in the UK began to fail, and everybody's familiar with the rest of the history. We get a chance to listen. There are canaries in this game telling you not only when to buy at the coalface, but when to sell. So the answer to that question is the easiest way is to collapse the gross. For the other products on the long-only side, it's about fund structure, it's about longevity of the relationship with the client, and it's about accepting the volatility that goes with the space. You can't hedge microcaps in a long-only fund structure. The client base has to understand that, and it's an illusion of control to think that we can.
But you wouldn't mention, but that canary gave him a really good heads up as to the gross and his overall exposure. And in 2008, they were barely down. And 2009, they were able to take advantage of gargantuan misvaluations. So interesting. Okay, Brian?
I'm curious about your incentives to continue to focus on microcaps. Relatively small amount of money for management in your space. Do you invest personally in your funds? To what percentage might you hold in your firm's investments? And how do you resolve that in terms of conflicts or not?
Brian?
So we're a little bit unique in that we run separate accounts. We don't have a fund per se. And so we adopted a CFA best practice that says that access persons have to wait until the day after clients are finished buying before they can take a position in the names. I got into the business because I love stock picking, I love the treasure hunt, and I don't want to quell that desire for anybody on our investment team. And so I allow them to buy whatever they want. And the long and short of it is that most people buy exactly what is in the client portfolios because it's our highest conviction ideas. The problem is that we have to wait until the day after we're done accumulating for clients. And so our personal portfolios reflect sometimes the torture of chasing rising stock prices. And so we're disadvantaged relative to our clients from that standpoint. But the bottom line is we want as much of these names as we can personally. And so, 100% of my net worth outside of my personal residence is in the same 20 names that we hold for clients.
For us, we're structured as a private equity fund, and the investors of the fund own between 2 and 4%, have committed about somewhere between 2 and 4% of the capital, depending upon the fund. And for safety reasons, we ban all of our professionals from investing personally in microcaps.
Okay.
So the three funds, I don't invest in the hedge fund. The reason is quite simple. Is my exposure. My second largest personal exposure is in the conviction portfolio of best ideas. All those names are reflected in the hedge fund, but I'd rather have the personal exposure to the conviction names within the hedge fund, and I'd rather have the outsized return. And my largest personal investment is in the recently launched Catalyst fund, which we launched in May last year.
Okay. Another question? Okay, I've got one which it's a shame to end it on this question, but we had the very large opportunity after the 2008 crisis. Liquidity's everywhere. How much liquidity's gotten to your space, and what are your valuation parameters, concerns? Why don't we start with Tom?
What you saw after the recovery. Let's take a step back and say, what drives microcap share prices? It's largely retail inflows. So what you'll typically find, and what you found in this downturn, is that retail investors are the last investors to return to the market. So from 2008 through 2012, microcaps actually materially lagged the recovery. Retail investors came back in very strongly. So if you look at the overall market from 2008 to 2013, what you'll find is that microcaps now have appreciated at the same level as the overall market has appreciated. Our concern is those valuations are pretty pricey right now. I said to you, 30% of microcaps trade at 8 times EBITDA or less. I could have probably told you 6 years ago that 70% of microcaps traded at 5.5 times EBITDA or less. So for us, it's a time to be really cautious, to preserve cash, and really just invest in a very few select number of names. And to get value right now, what we believe is you really have to invest in somewhat broken companies that you think that there's something containable that you can actually fix. Otherwise, I think value is very, very hard to find in this market, even in microcaps.
Brian?
So I would mimic a lot of what Tom just said, and I would add a couple things. The first is I think that the names that have where there's obvious organic growth in the microcap space are largely overvalued. The Stratuses of the world, where there's a long runway for growth, 20, 30% revenue, top line growth year after year after year. Those names have gotten to sort of nosebleed valuations. In our view, the opportunity set generally has gotten more expensive. The time for selectivity is now. There's still, with so many names in the space, there's still plenty of opportunity. But I would say that buying the Russell Microcap ETF or the DFA Microcap Fund, you're probably paying, when you look at historical averages, a slight premium. I'd also add on, the DFA Microcap Fund currently, it's been rebranded. It's not called the 910 anymore. It's called the Microcap Fund, and in part because it's $5 billion in assets, and the average market cap is now over $1 billion of that fund. The Russell Microcap ETF, the average market cap is $500 million. And the CRISP 910 average market cap is $250 million. So that gives you an idea of how these firms and entities are trying to accommodate a much larger asset base. And it's largely the result of, the appreciation of the space as well. And so I'd say, it's probably not the time to put a bunch of money in those products.
And very quickly,
underlying liquidity in the UK asset class has probably doubled over the last year. So it's definitely a much healthier place. Back to the observation at the outset for us, asset class, opportunity set rather than asset class. The valuations are clearly higher, but put some colour on this. On AIM last year, 100 companies left and 100 companies joined. I have a chip on the shoulder about opportunity set over asset class. What I'm confident at is, if I look at what the list of names in 5 years' time, that is our opportunity set, it will be a very different list of names, just as it is today compared to 5 years ago. So, stock specifically, and generically buying the market, broader observations, we've been through 2 or 3 years of what is a reflation trade. The QE impact has lifted all assets, and I think when we look back on 2014, we'll find that dispersion is returning, differentiation is returning. I hate the phrase stock pickers market, but I do think we'll see the reassertion of traditional factors in driving stock prices across most asset classes, and that being those who are delivering will continue to make progress, and those failing to deliver will start to get punished. So I think you'll start to see much greater dispersion of returns amongst fund managers from this point forward.
Okay, unfortunately I have to get close to calling a close, but I wanted to thank a number of people. Connie Sledge, who's our rock at the Roundtable, and the staff of the Roundtable, Steve McMenamin, for being the head of the Roundtable since 1996. Special thank you to Chris Lang and Cornerstone, recent members who volunteered the idea of having Brian Bears come. Kevin Schuyler's here. Thank you very much, Cornerstone. Bill Kelsey from Henderson, very helpful in getting Adam over. And lastly, I would just say, I think we've heard from some very interesting fiduciaries today, some stewards of capital, some serious people, really masters of their space. I found it a privilege and very interesting. So thank you very much to our speakers for attending and helping us today.